That is to say, they allowed some of the banks that were under TARP to begin buying back stock and raising their dividends. It's the kind of thing that drives free marketeers like us, and not to mention Jim Rogers, absolutely nuts. Let's take a look.
Jim, how is QE2 quantitative easing going to end?
Well, it's going to end with higher interest rates, higher inflation, lower U.S. dollar, currency turmoil. It's going to end very badly for all of us. I mean, it's a disaster what they're doing. The good news is that they're making so many mistakes that ultimately will mean the demise of the Federal Reserve, and we'll finally get rid of the central bank in the United States.
Dare to dream. In the meantime, and I'm not sure we can do this, but I believe as stock commenting guys, we have the power to choose the next Fed chair. I just chose you. What is the best strategy we can do for the smart guys?
Close the Federal Reserve.
So you just shut it down on day one.
Yes, look, we've had 3 central banks in U.S. history. The first 2 disappeared. This one's going to disappear too. Between Greenspan and Bernanke, they make so many horrendous mistakes. 3 years ago, the U.S. Central Bank had $800 million of government bonds on its balance sheet. Now it's got, who knows, maybe $3 trillion of garbage and junk, and they continue to add more to more leverage, more money in circulation, more currency. I mean, this is a disaster for all of us. Look, without a central bank, the world has problems, but the world doesn't have as many problems as this central bank is imposing on us as American citizens and on the world.
Let's say the Ben Bernanke and the current central bank folded up shop tomorrow. The problems don't go away; they're still there.
Well, fine, I agree. But right now what we have was problems in the central bank throwing gasoline onto a fire. At least somebody's got to try to put the fire out. If we didn't have a central bank, we could start figuring out how we're going to put the fire out. These guys are just stoking the fire.
So when Ben Bernanke says he has the tools ready to go to extract himself from this situation, your reply to him?
Oh, please, you're bad for my nervous system. Come on, the man has never been right. You go back, I mean, there are people doing studies of everything he said in the 6 or 8 years he's been in Washington. The man's never been right about anything. Why do you guys even listen? I guess you have to because you're the media. But he's never, the only thing I would pay attention to Bernanke for is as a contrary indicator. He has never been right.
One of the big underpinnings for this rally, this doubling of the stock market, sure we've given some back from the highs earlier in the year, is the Fed money pouring in. We've had people say that as soon as that stops, we could see the S&P 500 give back 20% quickly. I mean, is the equity market gains domestically in the U.S., are they that closely linked to the Fed pouring money into the bond market?
Well, the U.S. pouring money has certainly had an effect. When there's lots and lots of money sloshing around, it's got to go somewhere, whether it goes into stocks or bonds or currencies or commodities or shorts. It's got to go into somewhere. So, yes, it's got a big effect. The problem with that scenario is everybody expects it to happen. So usually what happens is something else happens because people are geared up expecting that to happen. I would not be surprised if something else happened. But the stock market needs to have a rest. I mean, you pointed out it doubled in 2 years. That's not normal.
But people argue, Jim, they'll say, well, geez, the earnings are strong and growing, and on a relative basis versus pouring money into treasuries, stocks look good.
Well, I certainly wouldn't pour money into treasuries. You asked before about my my expectations list. I'm gearing up to short the U.S. Treasury again. Yes, stocks have been great, but I would remind you that profit margins in the U.S. are at the highest they've been in 18 years. Now, when you have something that's the highest in 18 years, it usually doesn't get much better. It might get some better, but not a whole lot. So what is there to look forward to? Well, not very much.
Maybe a decline in your short positions. You're short the NASDAQ. Is that just across the board on the entire kind of NASDAQ complex, or are there specific areas of the NASDAQ that you're particularly bearish on?
I'm short the technology ETFs. I'm short it. ETFs are wonderful these days. You can do a lot very easily and very quickly. And when I was looking for things as hedges, the emerging markets and the NASDAQ technology stocks were the ones that have gone up the most. That's where the biggest excesses are. That's why I shorted there.
And one final question, Jim, if we can clarify. You had mentioned you're short the emerging markets as well. That's actually been working out well for you. Does that story turn around and change and you get long, again, the emerging markets?
Well, I said before, I'm watching what's happening and expecting to act sometime if the markets keep